Most investors study numbers first: revenue growth, margins, valuation multiples, balance sheets. These metrics feel solid, objective, safe, but financial celebrities who built fortunes through individual stocks eventually discovered a harder truth. Numbers explain what has happened, not why it happened, and rarely whether it will continue. For that, they learn to look elsewhere at the people running the business. Evaluating company management is uncomfortable because it resists precision. You cannot spreadsheet integrity. You cannot backtest judgment. And yet, over long horizons, management quality determines whether a good business becomes a great investment or a value trap disguised by temporary success. Financial celebrities came to see management as the steering wheel of the company. The road matters, but the hands on the wheel decide whether the destination is reached or missed entirely. Early in their careers, many investors ignored management. They assumed incentives aligned automatically, that executives would act rationally, that growth implied competence. Books and biographies show how costly this assumption proved to be. Companies with strong products collapsed under poor capital allocation. Promising firms diluted shareholders into irrelevance. Brilliant technologies died under leaders who could not prioritize. Financial celebrities learned that management reveals itself not through charisma, but through decisions under constraint. Anyone looks capable during favorable cycles. The true test appears when growth slows, margins compress, or capital becomes scarce. How leaders respond in these moments exposes their philosophy far more clearly than any earnings call during boom times. One of the first lessons is that management quality is inseparable from capital allocation. Where does excess cash go? Reinvestment, acquisitions, debt reduction, buybacks, dividends. Financial celebrities scrutinize these choices obsessively. Poor capital allocation can destroy shareholder value even when the underlying business performs well. Great capital allocation can rescue mediocre businesses and turn them into compounding machines. Another critical insight is that incentives shape behavior more reliably than words. Financial celebrities learn to read compensation structures carefully. Are executives rewarded for per-share value creation or for size, growth, and headlines? When compensation rewards empire building, shareholders usually pay the price. When incentives align with long-term ownership, decisions tend to age better. Communication also matters, but not in the way most people think. Smooth language is cheap. Clarity is rare. Financial celebrities paid attention to how management explained failures, not successes. Did they take responsibility? Did they blame external forces? Did explanations evolve with new information or remain rigid? Consistency with reality mattered more than consistency with past statements. Another revealing dimension is how management treats shareholders. Not rhetorically, but structurally. Are shareholders diluted casually? Are promises quietly revised? Are buybacks executed opportunistically or mechanically at peaks? Financial celebrities learn that respect for shareholders shows up in restraint, not friendliness. The absence of abuse mattered more than expressions of loyalty. Long-term investors also watched how management handled growth. Growth pursued at any cost often masked fragility. Financial celebrities preferred leaders who understood when not to grow, when to walk away from marginal returns, when to protect culture and balance sheets rather than chase quarterly targets. Restraint, paradoxically, often signaled confidence. Another subtle but powerful indicator was management's relationship with time. Short-term thinkers optimize for the next quarter. Long-term thinkers invest for years they may not personally benefit from. Financial celebrities admired leaders who spoke in decades, not months. This temporal alignment with shareholders created trust that numbers alone could not. Crisis behavior offered the clearest lens of all. During downturns, did management cut waste before cutting muscle? Did they preserve optionality or gamble for resurrection? Did they communicate transparently or disappear behind vague statements? Financial celebrities often said they learned more about a company in one bad year than in 5 good ones. There is also the question of adaptability. Markets change, technologies evolve, consumer preferences shift. Financial celebrities valued management teams that could revise beliefs without losing identity. Stubbornness, disguised as conviction, destroyed more companies than uncertainty ever did. The best leaders were firm on values and flexible on methods. Another lesson emerged around ego. Founder-led companies could be powerful or dangerous. Ego fueled vision, but also blindness. Financial celebrities did not avoid ego, they monitored it. Was the leader surrounded by independent thinkers or loyal amplifiers? Did dissent survive? Culture at the top cascaded downward with brutal efficiency. Importantly, management quality cannot be evaluated in isolation from context. A great manager in the wrong industry may struggle. An average manager in a monopoly may thrive. Financial celebrities avoided absolutism. They evaluated management relative to the challenges they faced. Competence was measured against difficulty, not against perfection. Over time, experienced investors stopped asking whether management was good or bad. They asked whether management's incentives, temperament, and decision patterns aligned with the kind of returns the business model required. Some businesses demanded discipline, others demanded creativity. Misalignment here proved fatal. Another overlooked aspect is succession. Companies outlive leaders. Financial celebrities paid attention to whether management was building institutions or cults of personality. Succession planning signaled humility and durability. Its absence signaled fragility. As portfolios matured, financial celebrities often concentrated capital in fewer businesses, but only where management trust was earned slowly. Trust once earned reduced the need for constant monitoring. It allowed patience through volatility. This trust was never blind. It was conditional and revisited continuously. And this is where the story begins to narrow. Because once management is understood not as a qualitative footnote, but as a compounding force capable of amplifying both strengths and weaknesses, the entire process of stock picking changes. Numbers still matter. Markets still matter. But behind every durable investment stands a group of humans making decisions day after day, shaping outcomes long after the initial thesis is written, revealing that the real risk is not volatility, but misjudging who controls the capital you have entrusted. As the evaluation of management becomes less about predicting brilliance and more about avoiding predictable failure, unfolding slowly through observation, patience, and pattern recognition, like learning to read weather not from forecasts, but from the pressure in the air and the behavior of animals before the storm arrives. And this is where evaluating company management moves from intuition into disciplined judgment, where experienced investors stop asking whether leaders are impressive and start asking whether they are predictable in the right ways. In the second half of this lesson, financial celebrities converge on a quiet but powerful realization. You are not investing in people at their best. You are investing in how they behave when conditions are least forgiving. Charisma fades. Vision is tested. What remains is habit. Management quality, over time, is nothing more than repeated behavior under different pressures. The most reliable investors learn to observe management longitudinally, not episodically. One quarter tells you nothing. One acquisition tells you little. Patterns tell you everything. Do leaders consistently overpay when markets are hot? Do they promise synergies that never materialize? Do they reverse course without acknowledging error? Financial celebrities catalog these behaviors mentally, understanding that repetition is not coincidence, it is character expressing itself through capital. Another crucial insight is that great management teams are often boringly consistent. They do not reinvent strategy every year. They do not chase every trend. They communicate in plain language. Financial celebrities learn to distrust excessive complexity. When explanations require constant reinterpretation, accountability dissolves. Simplicity in management communication often signals internal clarity. Trust is built not by success, but by honesty about failure. Financial celebrities paid close attention to how management spoke when things went wrong. Did they adjust compensation downward? Did they change processes? Did they admit mistaken assumptions? Leaders who internalize blame tend to correct faster. Leaders who externalize blame tend to repeat mistakes with greater confidence. Another decisive factor is how management treats capital when opportunities are scarce. Anyone can invest aggressively when growth is abundant. The true test appears when good options disappear. Financial celebrities admired leaders who returned capital patiently rather than forcing activity. The willingness to do nothing to wait, often distinguish stewards from gamblers. There is also a subtle but telling relationship between management and leverage. Leaders who respect uncertainty treat debt cautiously. Leaders intoxicated by control treat debt as entitlement. Financial celebrities learn that leverage magnifies management quality in both directions. With great managers, it accelerates compounding. With mediocre ones, it accelerates ruin. Succession planning becomes increasingly important as investments age. Financial celebrities understood that a company's durability depends on whether excellence survives the departure of its leaders. When all value is concentrated in one personality, risk is hidden. When systems outlive individuals, resilience emerges. Institutional thinking mattered more than brilliance. Another overlooked indicator is how management responds to external critique. Do they engage thoughtfully with skeptics or dismiss dissent as ignorance? Financial celebrities valued leaders who could hold opposing views without defensiveness. This intellectual openness often preceded strategic adaptation before markets forced it. Over long holding periods, investors also noticed that great management teams tend to underpromise and overdeliver. They set conservative expectations. They leave room for error. They avoid heroic language. This conservatism compounds trust. Poor management does the opposite. Optimism today excuses tomorrow. As experience deepens, financial celebrities stopped trying to find perfect managers. They focused on avoiding predictably bad ones. Those who diluted excessively. Those who chased scale for ego. Those who optimized compensation over compounding. Eliminating these failures dramatically improved outcomes, even without finding genius. Eventually, evaluating management becomes less analytical and more observational. Tone, consistency, decision, cadence, capital humility. These signals accumulate quietly. The investor stops being surprised. When outcomes arrive, they feel almost inevitable, not because they were predicted, but because the behavior leading to them was visible long in advance. And so the lesson resolves into a demanding but empowering truth. Stock picking is not about finding great stories. It is about choosing who you trust to make decisions with your capital when you are not watching. Numbers tell you where a business has been. Management tells you where it is likely to go. If this reflection resonated with you, pause and ask yourself one question. If markets turned hostile tomorrow, would you trust this management team to protect your capital before protecting their image? That answer matters more than any valuation model. Share your thoughts. And if you want to keep learning how long-term investors quietly reduce risk by understanding people, not just numbers, stay connected. Subscribe, follow, and return. Because in the end, investing is not about predicting the future. It is about choosing the right decision makers for an uncertain one.